Hello everyone. Let me begin with the December monetary policy review, where the RBI maintained a status quo on interest rates, specifically on the benchmark repo and the reverse repo, which was significantly contrary to the consensus view, where the markets expected a 25 basis rate cut. So what really triggered this move? To our mind, obviously inflation was one of the key determinants, where the RBI believes that the impact of demonetization on inflation, A, would be very temporary, and B, the amount would be about 15 basis points. Number two is that the RBI also seems to be concerned about an impending Fed rate hike in the US, which is slated for later this month. And of course, there were some concerns on growth, where we have seen a 50 basis point reduction in the growth outlook. But I think the inflation story or the inflation hawk tone seems to have resurfaced back into the RBI's guidance. So while the target for March 17 has been intact at 5%, and we also believe that this number is likely, the final outcome is likely to undershoot RBI's expectation. It remains to be seen in the coming months how this event will actually pan out. So how did the markets react? Essentially, as we had mentioned, that the markets had discounted an outcome of a 25 basis rate cut. Therefore, the lack of it obviously led to a disappointment, and we saw yields back up or sell off in prices to the tune of about 20 to 25 basis points. The good news here is that the CRR hike, the 100% CRR maintenance on incremental deposits, that has been relaxed because of the MSS, which is market stabilization bonds, and the reverse repo facility. So at least the intent of RBI's keenness to maintain liquidity seems to be visible, and that we believe would likely continue to drive the markets going forward. It's liquidity and the expectation of interest rates which support the yield curve or try to do damage or destruction, like the kind of sell-off that we saw today. What should we expect as a view going forward? This answer, before I answer this question, I think one needs to fundamentally revisit all those ingredients which led us to believe that there could be rate easing going forward. And if you analyze each of those factors, including the likes of inflation, growth, liquidity, everything points to the fact that the accommodative bias can continue, and we therefore continue to expect a 25 basis rate cut by the end of FY17, that is March 2017. What should the strategies therefore be in this kind of an investment scenario? Again, no marks for guessing that for the temporary period, given that there has been a status quo and this probably would get revisited in the next monetary policy, the short-term yield curve would inch up a little bit, making short duration funds or ultra short-term funds attractive. Liquid funds would continue to have the reinvestment risk, though as I said, in the near term the rates have risen. But for those looking at opportunistic trades or who are having this left out feeling, or the fence sitters, I think this would be an appropriate time to allocate to duration funds like a gilt or bond, with in the yields getting the 10-year yields getting in the vicinity of 6.4 to 6.5%. I think this policy decision which was delivered in some sort reminds you of that very classic movie Chalti Ka Naam Gaadi, the song which says, Jate te Japan, pahunch gaye Cheen samajh gaye na. What I'm trying to say is that the destination probably might take a little while in terms of you reaching, but for sure we believe that you'll reach the destination. So fasten your seatbelts and stay invested. It could be fruitful. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.